about in a later lecture. The central bank has experts who study these issues 24/7. So the argument goes the central bank should have the flexibility to diagnose the problem and to react to it as it sees fit. But discretionary monetary policy has some practical problems. There are time lags, risks of overshooting, and what we call the problem of pushing on a string. Let me talk about those in turn. The time lag problem is, remember, monetary policy involves a chain of events. A central bank must perceive a situation in the economy, hold a meeting, and make a decision to tighten or loosen monetary policy. That change then has to percolate through the banking system, changing the quantity of loans, affecting interest rates, affecting aggregate demand. Then when interest rates change, businesses and consumers must change their investment levels and their borrowing patterns, and it takes time for these changes in buying power to filter through the whole rest of the economy. As a result of this chain of events, monetary policy doesn't have an immediate effect. Instead, the primary effects of cutting interest rates or raising interest rates are felt sometimes maybe 1 to 3 years in the future, maybe sometimes even longer than that. So, remember, the U.S. had a recession in 2001. The Federal Reserve slashed interest rates. The recession did end in 2001 in the sense that the economy stopped shrinking, but it really took until 2004, almost 3 years later, before employment growth and economic growth really started picking up again in a strong way. So there are time lag problems. A second problem with monetary policy is a risk of overshooting, where monetary policy creates more economic fluctuations than it resolves. Alan Blinder, a Princeton economics professor who served on the Federal Reserve Board of Governors, gives a useful analogy here. He says, say you go to a hotel room in the evening, and the room feels really cold. So what do? You turn the thermostat up a little bit. Nothing seems to be happening. So you want to go to bed, you turn up the thermostat really high, and you go to sleep. Well, you wake up in the middle of the night and your room is like a sauna. I mean, you're just sweating with how hot it is. So you stagger out of bed and you sort of whack the switch on the thermostat. You wake up in the morning and the room is like a refrigerator. It's just icy. Now, what's the lesson there? The lesson is that when things take some time to react, it's easy to go too far. It's easy to push way too far toward heat and way too far toward cold because you're impatient for something to happen. Now, in your hotel room, this isn't a tragedy, it's just uncomfortable. But if the Federal Reserve reacts in that way, and it drives the economy through cycles of inflation and recession and back and forth, that is not a good outcome at all. A third issue is that monetary policy might be better at contracting an economy than at stimulating it. There's an old proverb that says, you can lead a horse to water, but you can't make him drink. Similarly, a central bank can buy bonds from individual banks, so the banks have more money to lend, but the central bank can't force the banks to lend out that money. Maybe the banks think the economy is going badly and they think it's a bad time to be making loans. They are worried a high percentage of their customers might default. If banks want to hold extra reserves and not loan out right up to the maximum, they're perfectly free to do so. You can lead them up to water, but you can't make them drink. In this setting, using monetary policy to fight a recession might not work especially well because the banks don't want to lend out the money that you give them. Japan experienced this situation in the 1990s and the early 2000s. Japan's economy had entered a period of very slow growth, dipping in and out of recession in the early 1990s. By February 1999, the Bank of Japan actually lowered its federal funds interest rate, or its equivalent in Japan, to 0%. And it kept that rate at 0% most of the time through 2003. Moreover, in the 2 years from March 2001 to March 2003, the Bank of Japan expanded the money supply of Japan by about 50%, which is an enormous increase over 2 years. But even this amazingly expansionary monetary policy had no substantial impact in stimulating aggregate demand. Japanese banks didn't want to lend out the money. Central bankers have an old saying that monetary policy can be like pulling and pushing on a string. When a central bank pulls on the string and uses contractionary monetary policy, it can definitely raise interest rates and reduce aggregate demand. But when a central bank tries to push on a string of expansionary monetary policy, sometimes when you push on a string, the string just folds up and becomes limp, It doesn't really have any effect because banks decide not to lend out their extra reserves. Now, that's not an absolute rule that banks can never stimulate an economy, but it can be a concern in certain situations. Finally, it's worth pointing out that a central bank can have different priorities than politicians or citizens. There will sometimes be disagreements over what's most important or how aggressive policy should be. A policy of discretion means the central bank has the freedom to make those choices rather than someone else. Now, this mixture of difficult practical issues, especially the risk of overshooting, has led to some interest in whether we might be able to develop a rule that central banks could follow. Let me describe some of the possible rules. One possible rule for a central bank is that it should increase the money supply by a fixed percentage rate each year, which would reflect the average rate of real economic growth over time. So, if the economy is growing at a real rate of 3%, the money supply would also grow at a real rate of 3% each year. The advantage of this kind of a rule, it would avoid the problem of overshooting or undershooting. On average, over time, money would grow about as quickly as the economy. And for a time in the 1960s and 1970s, this kind of rule, where the money supply would grow at a fixed rate of time, was very popular. These rules had the advantage that inflation would be kept low over time. The Fed wouldn't be trying to guess what's going to happen with the economy. The Fed wouldn't overreact and make matters worse rather than better. The intellectual godfather of this movement was Milton Friedman, the great economist who wrote in 1967 that the first and most important lesson that history teaches about what monetary policy can do, and it is a lesson of the most profound importance, is that monetary policy can prevent money itself from being a major source of economic disturbance. And so that idea was to just have the money supply grow at a fixed rate. Now, that idea works well if the ratio of the gross domestic product to the money supply is constant, so that the money supply and the economy grow together, or at least in a predictable way. But in the 1980s, the ratio between money and GDP began to vary substantially. If you look at a graph, GDP divided by the money supply, which is what economists call velocity, how much money circulates through the economy. From 1960 up to about 1980, you get this very stable relationship. So it's very easy to look at that and say, well, money is circulating in the economy at a steady pace. It's easy to think about things growing in a steady way. But in the early 1980s, you do that same calculation, GDP divided by M1, and all of a sudden your graph begins to bounce up and down and up and down. It becomes quite variable. Now, the reason why this relationship between M1 and GDP changed so sharply remains something of a puzzle. Economists suspect that it has something to do with the innovations in banking and finance, which have changed how money is used in making economic transactions. The growth of electronic payments, a rise in personal borrowing and credit card usage, the accounts that make it easy for people to hold money in a savings account, where it's counted as M2, right up to the moment where they want to write a check and they transfer it over to M1. So these lines about what money is blurred. But whatever the reason, these dramatic and variable changes in the relationship between money and GDP mean that having a fixed growth rate of the money supply won't work very well. Perhaps the preferred method of setting monetary policy today is called inflation targeting. And many countries actually rewrote their central banking laws in the 1990s to use this policy. Inflation targeting means the central bank is legally required to focus on one goal, keeping inflation low. And by the early 2000s, about 20 countries from all over the world, their central banks had a legal requirement to target the inflation rate. Those countries include Austria, Brazil, Canada, Israel, Korea, Mexico, New Zealand, Spain, Sweden, Thailand, and the United Kingdom. Indeed, the legislation that established the European Central Bank, which controls the euro, set price stability as its primary goal and defined it as an inflation rate of 2% per year. Now, the advantage of inflation targeting is that it makes the central bank accountable and transparent. It avoids the risk of some discretionary boom and bust economic cycle driven by the central bank. But under law, the U.S. Federal Reserve is required to pay attention to both unemployment and inflation. In practice, what this seems to mean is that the Fed should reduce interest rates during recessions and raise interest rates if inflation appears to threaten. But, what if there's both high unemployment and high inflation like the 1970s? Since the late 1970s and early 80s, the Fed policy seems to be make sure inflation is low first and foremost, and then worry about unemployment after that. But in 2001, when there was a recession, clearly the Fed aggressively moved against cyclical unemployment. No nation, with a developed economy at least, conducts its monetary policy through the legislative or the executive branch of government. Instead, they all set up a sort of quasi-public agency that's somewhat independent of politics. Why is monetary policy conducted in so undemocratic a manner? Well, let me give you the case for having monetary policy made through a more democratic process. It goes something like this. After all, elected representatives in Congress and in the presidency conduct fiscal policy by passing tax and spending bills. They could handle monetary policy that way. And let's remember, this argument goes, the people appointed to the top governing positions at the Federal Reserve and most central banks around the world are bankers and economists. They are not representative borrowers. They don't understand the needs of small businesses or farmers or labor unions. If central banks had more democratic representation, they might not be so quick to raise interest rates if they had to pay attention to the firms and the people who are borrowing money in the real economy. Sure, this argument continues, democratic monetary policy will sometimes make mistakes. But after all, we're in a democracy. It is better to have mistakes made by elected officials accountable to voters than by these insulated political appointees who might not be representative of voters. So that's the case for more democracy in monetary policy. What's the case for more independent central banks? The case would be that because the central bank has some insulation from day-to-day politics, its members can act in a somewhat nonpartisan way, and they can make tough, immediate decisions when they need to. After all, a central bank does act according to laws passed by elected officials, but it can respond far more quickly than a legislature. The U.S. budget takes months to get passed and to be debated and passed and signed, but monetary policy decisions can be made much more rapidly. They can call a meeting and decide to change monetary policy every month or more often if they want to. The argument for a more independent central bank is that day-to-day democratic control of monetary policy is impractical. And also, it seems likely to lead to an overly expansionary monetary policy and higher inflation, where people are always trying to provide more loans at lower interest rates. Countries are reluctant to trust politicians with the power to make borrowing easier. And they're reluctant to trust politicians with a responsibility for raising interest rates when necessary. It may be that politicians have sort of a short-run horizon for monetary policy. And they'll be more likely to say, well, we need to act now to get interest rates down. And they'll be more likely to overreact in a way which would cause monetary policy to contribute to big fluctuations in the economy rather than helping resolve those fluctuations. Politicians may also not be very willing to respect the idea of a natural rate of unemployment. They might say, well, unemployment's 5%, let's get it to 4%, 3%, 2%, 1%. And as they try and push unemployment unsustainably low, they're going to create both an unstable macroeconomy and one that has a built-in bias toward inflation. Now, when you get the inflation, you'll need a recession to fix that inflation later on. So, bottom line here is that no nation uses a democratic vote to make monetary policy decisions. The fear is that elected representatives would find it nearly impossible to vote for higher interest rates. And the result would be the economy had a bias toward letting inflation get established and get stronger and stronger. When I think about this issue of central banks being democratic or not democratic, I think it's useful to think about judges. Central banks aren't democratic, but judges aren't democratic either. After all, America's judicial system is run by judges who are presidential appointees, and the judges interpret the laws made by elected officials. Few people think that the legislature should be voting on every legal case. And many of the same arguments apply to a central bank. Sure, laws are made democratically, and judges in some cases interpret the law. But if judges are really messing up in a big way, then the law can change, or in extreme cases, judges get changed too. Similarly, the rules that guide monetary policy are set democratically, like an inflation target or a money growth rule, or a rule that you have to balance unemployment and inflation. The central bank then applies and interprets that rule. This debate over democratic control of monetary policy isn't going away, but the most common trend in the first decade of the 2000s is countries around the world are moving toward writing specific rules for central banks to follow, like targeting inflation, and then leaving it up to the central bank to achieve that goal, instead of moving toward greater democratic control of the central bank.